First of all, I apologize if any of the tech goes wrong. We know that the NBN is under pressure right across Australia because more and more people are working from home. We will do everything we can to mitigate things as far as we possibly can. And we'll just do the best that we can. I think what we'll do, we'll get kicked off because the intention is to be on stream for about 45 minutes to an hour. So I'll make sure that when I introduce you to Brad, he'll go through the process of asking questions and that type of thing. We have had some people ask questions before when they registered, so we'll definitely get to those. So what we'll do then is we'll bring up the individual panelists, these wonderful panelists who have donated their time very generously today to help the startup community as a whole. And I think, just to give you a little bit of background as to why we're doing this, basically last weekend, I'd been doing the social distancing like everybody else for the last 4 or 5 days prior to last weekend. And I felt this sense of a bit of social isolation rather than social distancing. And it just hit me that a lot of startup founders are going to suffer really badly with some of the mental health or some of the problems that are going to materialize. And these wonderful folks here have donated their time so generously to help out. So I'll just pass through to the first one. If we can just bring up Cheryl's slide, then Brad, that would be awesome. So Cheryl, first of all, can you just give us a quick 30-second introduction to everybody as to who you are and what you're working on?
Yeah, absolutely, sure can. So most of you probably know me from my days as being the CEO of StartCon, which was the largest startup and growth conference in Australia. I'm very involved in the startup ecosystem. I'm an activator at GEO, and most recently, I have just joined Stone & Chalk as their national head of community and communications. So I'm really excited to be working with and helping to support the 250 plus startups that are part of that network.
Excellent stuff. Thank you, Cheryl. And we'll then move on to the next panelist on our slide, Brad, which is, sorry, I just want to make sure we get the right, that's it, here we go. It's Sydney. Now, I'm going to make an apology up front because I always get his name wrong, and I apologize. So I'm just going to say, here's Sid, and he can actually say what his name is.
Thanks, Tim.
Okay, Sid, thank you.
Thanks. Hello, everyone. I'm Sydney Catchwella. I'm an accounting and financial planning individual who's been in the industry for about 10 years. I started a business with a couple of friends called Pop Tax and Pop Business, and we're aiming to reinvent and refresh accounting the way it is experienced. And tonight we'll be talking about some interesting stuff coming out from the government stimulus. So happy to get into that later on.
Awesome. Thank you, Sid. That's great. And thanks for pronouncing your name. It saves me the embarrassment.
Lots of practice.
Thank you. No, I know. I need plenty of practice. Excellent. And next we have, I'm just trying to think, we have Tim Heesh. Tim, give us a quick intro, please.
Great. Thanks, Tim. Hi, everyone. I'm a insolvency and turnaround advisor in Sydney. I lead up a small team of 12 guys. Our focus is on trying to preserve and create value in very, very difficult situations. What I'm working on at the moment is, with this changing landscape, what are some of the logical ways to assist business in this landscape, and trying to fully understand the drivers influencing many business decisions being made so I can best use my skill set to assist business in navigating these turbulent times.
Excellent stuff. Thank you, Tim. And just as a point of reference, I've known Tim when I was in banking, and I used to get involved in lending in some difficult situations. And Tim was, I have to say, one of the strongest insolvency practitioners that I knew at the time, who had a really good bedside manner. And I mean that in a very positive sense. So, not all insolvency practitioners are as ethical as Tim, let's say. So if you do ever face that situation, at least explore, bring Tim into the mix. That's definitely what I'd say.
Thank you.
And then we have Trina.
Trina Blaise, CEO FD Global Connections. I started the business in 2014 Having lived and worked in the US, upon returning to Australia, FD Globals was created. I work with Australia's most innovative companies to get them ready for the US market and launch them in the US. And I'm also delighted to say, and I know there are many people here from Stone & Shook, that many of my clients have joined my accelerator into New York. So great to be here, and thanks, Tim, for the opportunity.
That's great. Thank you, Trina. And then I'll introduce you to Brad, if I may, who is working all the technology behind the scenes. So Brad, just give us a quick intro as to who you are, and then we'll get straight into it.
Great, thanks, Tim. Yes, hi, I'm Bradley Hughes. I'm a co-founder of Fractonium, working with Tim on fractional funding platform for all kinds of asset classes. I've been in the blockchain space full time for 4 years now. I'm a co-organiser of Blockchain Sydney, the Sydney chapter chair of FIBRI, which is the Foundation for International Blockchain and Real Estate. And I'm the COO of Fractonium, and here to assist with questions behind the scenes and managing the live stream discussion on YouTube as well, if there is any. Okay, thanks.
Excellent. So I think if you've got any questions, please just, you'll see in the interface, you're able to ask questions. Brad will be filtering those, and we'll actually put those across to everybody. I guess the key thing that I just want to say is it's very easy for us to talk ourselves into recession, and that's not what this live cast is about. I mean, I'm not a millennial. I'm a pre-Jurassic, I think, is probably what I would define myself as. And it's very much, I've been through 2 recessions, and I know how difficult recessions are. And I'm not trying to be a smart ass or anything like that. But I think the key thing we all have to understand, as this is going to get a lot worse before it gets better. And we've got, such tumultuous times that we're facing. It's all changed in 3 weeks, which is just insane. So with that, I'd just like to ask each member of the panel then, okay, how likely do you think we are to face a fully blown recession in Australia, and how deep will it be? Let's get it to you, Tim, first, because you're obviously right at the leading edge of dealing with some challenging situations. What's your sense?
Sure. That's an interesting comment, that I'm the cutting edge. There's actually, I think, a little bit of a hiatus, which I can talk about later. I think there's a lot of watch and see at the moment, and there's some reasons for that. That said, I think the recession is very likely to happen. If the stats come out, it'll probably indicate that we're already there. How severe the impacts are going to be will vary in duration, timing, and impact. It's too early to say where the real losses are going to be felt. Some of the obvious industries, but post the virus, most of these industries will pick themselves up, and there will be some good opportunities. But yes, it's going to be a recession. Don't know how deep yet.
Okay, Cheryl, what's your take on it? You've been talking to a lot of investors over the past few days. What's your sense, or what's their sense of how deep it's, or is it going to be a recession, and how deep?
Look, I don't think that I am in a position where I would feel comfortable predicting a recession one way or the other. But what I will say is that whenever we see economic downturns, things slow down and they get harder. And that's exactly what we are going to see. And, talking to investors, the word on the street is that this is going to persist for at least a year. Okay,
interesting. Sid, go on, you're an accountant. Accountants always... good at valuing. No, what do they say? They can cost everything and value nothing. No, I'd never say that. Go on, Sid.
Yeah,
give us your views.
It's a very interesting time. As you all may know, that Australia's avoided a recession in the past 25 years, so we've done pretty well. And unfortunately, it's probably going to, who knows? As we're all saying, we don't really know, but it is very likely. So I think tonight's discussion is how can we help startups make the right decisions in the near-term future, and then work through this period to allow them to come out stronger. So speaking to investors, other people that invest in property and the share market, for the past couple of years, everyone's been saying asset prices are too high. So it's very interesting that this might be the reset button, allowing asset prices to come back down, and an opportunity for everyone to get in if anyone has dry powder.
Okay, excellent. And Trina, what's your thought?
Are we facing a recession? Again, I'm not an economist, but certainly from all the readings and everything that I'm reading, there is going to be a recession. I think how deep will it be? I have no idea. But what I would say is what's important is for businesses to do their scenario planning right now, understand the risks in their business and mitigate those risks.
Mm-hmm. What's your sense? I mean, you have a lot of US customers. I mean, with Goldman Sachs coming out last week and suggesting that Q2 might be a 20%, even a 30% fall in GDP. Is that sending real fear through the clients you're dealing with in the States?
The clients that I'm working with in the States, so there's been a mixed reaction. So a number of clients, depending on the stage of their scale-up activities. So if they're early stage scale-up, what they're doing is with the dollar that's dropped, they are holding back. They're just doing a bit more preparation within their businesses. But for those companies that have got strong pipelines, they've already got 1 or 2 clients over there, they're earning US dollars, which is good from a foreign exchange perspective. They're still going ahead. In fact, I had a call yesterday with one of my clients and one of our partners in New York, and they're still doing sales calls. They're still doing all of those activities. What we are seeing is there is going to be we think in terms of sales activities, we are going to see a slowdown in sales activities. There's no doubt about that, particularly while the Americans get involved in the work from home. But there's confidence in my network that will pick up again, as I think we'll see in Australia. Activity will come back to certainly not where it was, but there will be strong activity return once people do get used to this new working environment that we're in, using virtual calls, video conferences and everything. So that's what I'm hearing from my clients at the moment.
Yeah, I think I'd echo that in terms of just talking to a lot of people and doing a lot of research, that a lot of people think it's going to be a short, sharp shock. We'll get used to things and then we'll gradually come out of it. And I think, hopefully it's not going to be that protracted, but obviously we can never tell. I think the biggest concern I have is if when people suddenly see images of body bags, and that's the thing that's really going to put the frighteners up anything, everybody in the States especially, I think. I think over here, if we start seeing that, I think we're going to be, we're going to be quite concerned. So I guess my next question would really be, how equipped are startup founders to deal with this new landscape, and what should they look out for? I mean, give me a couple of things of what you think everybody should be looking out for in terms of the environment they're going to face. Do you want to kick off with that, Sid?
I think what I'm hearing from a lot of our clients is how are they going to maintain paying the fixed costs in their business? So rent, electricity, utilities. So that's the main big concern for everyone at the moment. And what we're doing is, how can we trim back those expenses, lock in some future profits, come up with creative strategies to work with their customers and their suppliers to ensure everyone down the supply chain has a bit of the pie. But I think strategizing with their trusted advisors is very important right now. So, taking as much information as possible from all sources, because triangulate the best decision you can make for your business and personally as well.
Are you seeing people cut back on expenses heavily? Are they taking those tough decisions?
I think they're mainly focusing on the fixed cost first, especially employees. Yeah. Employees, it's managing that relationship, trying to, figure out how they can keep them long as possible. So the upcoming stimulus with lodging your BAS, the government's going to cover up to 100% of the withholding. So that's cash flow back into the business, which, as we all know, cash flow is king. And it's an interesting time. So we're just trying to be as supportive as possible right now.
What's your take then, Cheryl? Do you think people are making those tough decisions. I mean, you know, the hardest thing for any founder to do is to say to, you know, somebody that joined their vision, sorry, we've got to let you go. Is that something you're seeing, or are you getting a sense of it? Is it, where does it, you know, what are you seeing?
Yeah, so look, first of all, I think startup founders are more equipped than they realize. Founders are naturally optimistic and also highly resourceful. So I do think that they are more equipped than they realize, or that we might even give them credit for. Okay. So that's one point. Second, on the hiring, look, again, these are decisions that have had to be made multiple times over. It's just at a slightly higher degree and a slightly shittier reason. Right? If you hire somebody and they don't work out, it's still a tough conversation. If you hire people and you end up not getting a contract that you thought you were going to get and you have to cut your team, it still sucks. These are conversations that founders have to make regardless of whether we are in an economic downturn. It just makes it that little bit harder because the reason sucks. But we're all in this together. And I think at this point in time, everyone is understanding that it sucks for everyone right now. So even, you know, my gym, I feel bad canceling my gym because it's a local boutique. Everyone is going to feel bad in this point in time. The one thing that I would tell people to look out for is false promises or false positives. You know, people don't like missing out on things during the best of times. They don't like saying no during the best of times. But when you add in economic stress, you're going to get people who are more indecisive and are more likely to say, yeah, we're interested, and lead you along when they actually aren't. So I would look out for that.
Okay, excellent. Good advice there, Cheryl. Now, Trina, we spoke this afternoon, and you mentioned the word about a lack of control that people felt. I mean, do you want to talk more about that?
Yeah, so I'll leave.
We'll come back to you in a second, Trina, I promise. Tim, can I get a thought from your side?
Yeah, I think I was just listening to Trina, and people feel a bit of lack of control. This is a situation that has arisen through no one's own actions, and the businesses that, whatever stage of business you are in, the businesses that have been impacted at the moment have been impacted by an external force that they couldn't really manage the risk for. That at one level is, well, we can't manage that risk, so we're not quite sure which way to move forward. But on the other side of it, balance sheets and were in pretty good shape at the start of this process. Usual failure occurs after a long gestation of a business model not working, and people and creditors building up and lots of problems with the business. This is a different scenario. So I would imagine that even startups, which you can appreciate as an insolvency person, I don't actually experience a lot of startups. They're still, their balance sheets and like at their starting point is probably still reasonably solid. It's just a matter of now trying to adjust their operations to meet what will happen moving forward in the short term, medium term, and long term. So it's quite a different scenario, and I'm not looking at it as bleakly as it might otherwise be, because we haven't had all of those insolvency events leading up to it.
Right. Okay. Interesting point. Sorry, Trina, we'll try you again. Sorry, well, we just couldn't hear you for a while there, so apologies.
Sure.
We'll try again just on the element of control. We got little bits of it, so
Okay.
We'll try again.
All right, so I'll just cover off again. So there are 4 stages of pandemic grief. It was an article in The Atlantic last week. Denial, panic, fear, rational response. It's a very interesting article. We're going to put the resources up. I encourage everybody to read that. But as I was reading that, what really struck me was this is a pandemic, which is very much every element
Sorry,
of our lives.
we're losing
it's
you again.
Home, it's work, it's our families, it's our colleagues, it's our.
I think we're having.
Normally, it normally attacks just one element, but it feels like we're totally out of.
Trina, can we possibly take your video off and just put you on audio? That might save some of the bandwidth. We're losing
Can you hear me? I've turned the video off. So
yeah, turn the video off. We'll just put you on audio. Then we can just, yeah. Okay, we're still
so
having...
what we think about in our lives is often we feel as if we're out of control. Okay.
No, we can hear you. Go on, continue.
And so what we need to do is we need to, I think, look at where we can get some control back. So if we think about business risk, there are 5 different areas in our business that we need to be looking at and managing from a risk perspective, and looking at things like financial risk, strategic risk, reputation risk. There are 5 risks. Again, we're putting that up for you.
Okay, so when you go on.
Making sure that each founder goes through those in detail, forensic detail, put actions against each of those, control again, that we do have some control over the different elements of our lives.
Right, okay, so have we lost Trina? Are you still there, Trina?
I'm still here.
Oh, you're still there, sorry. Okay, all right, so let's maybe just touch on a couple of those then. I mean, I guess from the customer's point of view, and just from you talking to customers in general terms, and we'll maybe look at this with Cheryl. Are you getting a feel for from some of the startups that customers are cancelling contracts, they're slowing contracts down, anything like that? Is that sort of thing coming through?
Yes, they are. Yes, they are.
Oh, sorry. Okay, you're on, Trent. Sorry. Okay, I wasn't sure if we could hear you, but okay, all right. Go on, continue on. Go on.
Yes. So what we're seeing is that contracts are being cancelled, contracts are being postponed, and so that is the issue that we're seeing at the moment. But those that are being postponed are confident that they're going to come back once we're through this worst phase.
Okay, let's move to Cheryl on that point. Are the startups you're liaising with, Cheryl, are they getting a sense of contracts either being deferred, slowed, stopped? What sense are you getting?
So look, the contracts that are in place are not getting all of a sudden canceled. Like there's no one out there, there's no enterprise that's saying, hey, I know we had a year-long contract with you, but we're going to cancel it right now. That's not happening. What is happening is that contracts that were in the process of, this was about to be signed, have now been completely stopped. Customers that can cancel because they are on a month-on-month basis are absolutely seeing a cancellation of sorts, but I wouldn't say that it's like on a mass scale. From the ones I'm talking to, they're losing customers steadily, and that will eventually plateau because there will be companies that see that particular service as essential, and there will be others that won't. So that will plateau at some point, I believe. But contracts aren't getting canceled, no.
Okay, but new ones are being. There's a bit of concern, a bit of concern about whether they'll go ahead or not.
Yeah, anything that hasn't been signed is essentially in jeopardy.
Yeah, we know that only too well. We're working with an international bank, and we're just riding the hiatus of that right now. So go on and Sid, you're the accountant. Contract gets lost, deferred, whatever it might be. Talk us through the revenue, how revenues are going to be affected and cash flow is going to be affected.
Certainly, we're going to see some accounts receivable becoming aged. Certainly, because I think the first priority for a lot of businesses will be their employees, and so I think contracts that have been going on for a while will remain. So it does come down to a relationship game as well. Similar to you, I think new contracts will definitely take a hit because of the uncertainty. Unfortunately, where there's uncertainty of future revenue or a deal, of course, those contracts will get pulled. And I think it'll affect different industries quite differently as well. Hospitality, as everyone knows, and retail, anything with a purely 90% physical base is going to be just unfortunately demolished, unfortunately. So thinking of creative ways to sell online and get back in touch with customers and suppliers.
I think you've hit a very valid point. You know, sort of, it's really got to work harder to get those customers, I think, isn't it? I think that's the key thing.
I think I've got a friend. Sorry, yeah, and I've got a friend in a bar, and he's doing some really amazing creative things to deliver cocktails to your house. So you know.
Oh wow, let's get his number.
Yeah, it's PS40. Check them out.
Right. Oh, I've been there. So he does those wonderful he actually does some wonderful cocktails. I've been there.
Yeah.
So come on, Tim. Let's have the brutal honesty here.
Right.
If contracts get lost, I mean, how many people do you see, or have you seen over the past 25 years of being in the insolvency game, come to you and say, "I've lost my major contract"?
Yeah, this is again, it's a different scenario. It's a tsunami that has hit particular sectors, and usually there's a business model that you can tease out, find out some value, negotiate with creditors, or do whatever you have to do through a more formal approach. But I think I agree with Sid. It's industry specific just at the moment. Sure, there's a broader impact, but certainly industries, the food chains, the entertainment, the leisure, the travel, they're all left with no redeeming features right at this minute, and
right.
There will be something on the other side of this, but there's nothing to build around for those industries that are absolutely dead in the water. And from an Australia's perspective, just at the moment, the construction industry for mine is nearly the major engine for the economy to be brought through this at the moment. If we're all told to go home, the construction industry will be part of that. The cash that generates is going to make it even harder for a softer landing and a harder to reboot it over the other side. So that's what I see as one of the big challenges at the moment.
Okay, well, let's cut to the chase then, because this is all about, ultimately, when you're running a business, it's all about money in terms of keeping the lights on, and that's a really important issue to look at. So let's get a sense from you, Cheryl. You've been talking to investors who may not be who are interested in their wealth and not they're interested in their health, but they're more concerned about the wealth that they're creating from businesses. What's the sense you're getting from those hard-nosed investors that actually invest in startups? Give it to us without the sugarcoating. What's going on?
No sugarcoating. So I'll relay a conversation I had with one VC. I asked, well, I've been asking VCs all week, are you parked? What's going on with your money? What are you doing? And I can give you guys that answer in a moment. But, one investor said, we're pretty much not looking at anything unless it's a current environment market opportunity. For example, if there was a video conferencing app or something that needed money right now because they needed to scale up to meet this demand, then I would absolutely put money into that. So I think there are definitely opportunities to make money, and there are definitely companies that are going to take advantage of this landscape, and investors are looking for those opportunities. And I think it's an interesting one to address, because identifying the ones that are going to survive this uptick is going to be the real question.
Right. So do you see venture capital being vulture capital?
They're all my friends, and I need to play nice with them. So I'm going to go with no.
No, not the individuals, but as a generic race of people with money who really just want to make money. They don't want to, or perhaps in the words of an investor that I know, he said, I don't want to lose money.
Look, I guess you have to look at it in two ways. There are the early stage investors, which I can tell you right now, early stage investors aren't getting in it just to make money. The time and effort and risk that is involved in early stage investing it's not for the person who just wants to make money. If you just want to make money and you have money, you put it into a diversified portfolio with a fund manager, and that's how you make money. So I would absolutely say if you're for early stage investors, no, they're not just vultures trying to make money. They genuinely care. They want to get involved. They want to give back. They want to help. They want to do something impactful with their time. The big funds, sure. I mean, like, does Gary Tan still care? I'm not sure. You know, does the guy running Garage Ventures still care? I don't know. I know they did when they first started. But yeah, you know, and maybe at some point it gets to a point where they're just trying to increase the value of their portfolio. But I also genuinely think, and I'm an optimist, but I do think that they genuinely care about their portfolios. If you look at what's happening right now with the big VCs in Australia and globally, they are looking at their existing portfolios. They are spending time with them. They are making sure that they're going to survive this valley of death. They're not being like, oh, how can we make money off you guys? Otherwise, they'd be like, you guys need to sell right now.
But I think in terms of you know, new approaches to angel investors and to VCs, I mean, is it still worthwhile for startups to approach early stage VCs and angel investors? What's your take on it, Tim? What are your thoughts?
Sorry, Tim, I was offline for a little bit. Could you just, I missed a little bit of the last bit, so could you?
I was just saying, is it still worthwhile for startups and others to approach early stage VCs and angel investors, do you think? Are you getting any sense?
Oh, look, it's not really a marketplace. The panel's much more alive to it than I am, but just from what I have heard and seen, there's always the view that if the markets go down and tumble, whichever area you're looking at, a lot of people that are cashed up and wanting to find a home for their money do actually see that as an opportunity. And it's a matter of finding the right opportunity under those circumstances. You know, there was a view in the PE market that the assets were very overvalued and they were looking for a circuit breaker. I don't think they wanted such a big circuit breaker, but they've certainly found one. And they're just waiting for the right time to jump in and pick up some very, very valuable assets at this point in time for good pricing. And I suspect that's the same with venture capital. Okay.
And Trina, we'll try you again. Hopefully we can the sound will be okay. What are you seeing? Are you getting a sense of how enterprise corporate venturing, that type of thing, might be viewing this?
Yes, I've switched over to a different Wi-Fi, so hopefully you can hear me now.
Awesome. Thank you, Trina. That's great.
Great. So what I'm seeing is that angel investors are very much shied away at the moment. I mean, most of their investment, and I am an angel investor, so I speak from experience here. I'm not looking to invest at the moment. I'm about protecting my own asset base. And I think a lot of angel investors are in that situation. What I also see, it's an experience that happened in the US in the Great Recession or the GFC. Investors are looking for, as Cheryl indicated, businesses that are going to leverage the experience and the issues that we're facing today. So in the GFC, we saw Facebook, Amazon, they received very significant investment during 2007, 2008. So I think that the larger investors and some institutional investors are still looking for those businesses that can flip, those businesses that have got assets that are taking advantage of the situation that we've got today, but also those companies that do have assets and that are looking to flip into something that can leverage the current economic situation and perhaps create new business models. The only other thing I would say is this. For those companies that have got investors, you've got to keep them updated. It doesn't matter how scary the situation gets within your business, you've got to keep them updated. Second point is, at the end of all this, if you're going to be looking out for investors, what I will be looking for as an investor is the way that you've approached this crisis, the way that you've thought about your business, mitigated the risks, the way that you have dealt with the hard decisions in your business. They are the things that I'll be looking for if you come to me in 6, 12, 18 months looking for capital. So I think it's really important that businesses do focus on managing their risks at the moment. If there are hard decisions that need to be made, they need to make them. And that's really actually going to set you up. It's hard now, but actually it's going to set you up much better when you do go to investors in the future and you can show them exactly the proactivity that you took. And remember that hope is not a strategy.
I think that summarizes it very well. A question that we were asked by this afternoon by Dale from Hillridge Technology. His question was, do you think this shock will have a permanent effect on investors, or is this just a temporary blip? And are there some investor types who will be back in the market sooner than others? Sid, do you want to take that?
Sure, Tim. Yeah, I think it depends on the appetite of investors as well. I think definitely it's going to take out the more risk-adverse types. They'll be moving into defensive assets, cash, gold, maybe commodities if they're comfortable with that. But I think investors are always, the riskier ones will be looking for a good return on investment all the time. So they always have their ears open, eyes peeled. So I think there's going to be a temporary blip, but because of the drastic drop of this sort of the loss in the market of the valuations, it's faster than the GFC. It's faster than any other prior sort of drop. So I think the bounce back will be quite quick as well. But it just depends when we see the light at the end of the tunnel. So hopefully once the last case disappears, investors will get that courage to go back in.
So for you, Cheryl, then, the last part of that question, are there some investor types who will be back in the market sooner than others? Do you think some of yours will come back in sooner than later?
Yeah, 100%. I think every investor has their own risk appetite, and that isn't going to change in the long run. That risk appetite will be the same as it was 6 months ago when we get through this. Now, that's not to say that it's a huge risk appetite. Australia in general has a risk-averse culture, and we need to remember that. So, we haven't had an amazing risk appetite in the past, but yes, it's going to come back to what it was before fairly quickly, I would agree.
Okay. So big question, and how do startups differentiate themselves to make them appear a more investable structure? Now, Trina, you said about proactivity. Tim, what do you think companies should do to make themselves more differentiated?
Wow, that's a big question under the current circumstances. It's around demonstrating that the business model that you have built and are building through these turbulent times will be resistant to shocks that could continue to go on. There is basically cash is king in all of this, and cash flows need to look like they're going to be resilient during it. I think
I can jump in on that one while we wait for other Tim to come back. So look, like I said, I've been speaking to quite a few investors over the last couple of weeks, and the one thing that has come out across many of them is customer traction. Startups are going to need to have a sharper value prop for their customers, and they're going to need to show customer traction in order to really show investors that they deserve investment right now, particularly for new deals. So when we say customer traction, we mean engagement. How often are your customers engaging with your product? How do they like it? What's the feedback? It's not just number of users. It's all about engagement. It's really, what are they doing on your platform? How often are they doing it? And do they love it or not? So if you can show that to potential new investors, that is the number one thing that's going to get you noticed at this point in time.
Okay, that's really sound advice there, Cheryl. That's great. I think what we'll do... Sorry, go on, Trina.
If I can just add one more point, Cheryl makes really great points there. If I can add just one more thing, we all know that it's cheaper supporting an existing client and selling to them than it is going after new clients. And so one of the things that I'm talking to my clients around in the US is, what is your share of wallet for that client? And do you have enough of that share of wallet? So the ROI on going after new business at the moment is always really higher. So look across your portfolio of clients, and if you do have an opportunity to try to sell in other products into those existing clients, then that, from an investor perspective, makes a lot of sense.
Okay, really sound advice there. Look, I think we're all agreed that probably investment's going to be a very challenging area. So maybe that gives us a perfect opportunity to look at other alternative sources. So Sid, you're doing a lot of work with lenders and with brokers in relation to the stimulus package. Do you want to give us a sense of what the banks are saying? And just talk to us about this unsecured package that you've been working closely with, and how are the banks and brokers reacting to it?
So it's still early days. The brokers and the banks are still taking in all the inquiries at the moment to figure out what the appetite is, but the appetite is very strong. So the exact details of what the lending requirements will be, I think in the next week we'll find more detail. But it's a joint effort between the RBA, Reserve Bank of Australia, the Australian Prudential Regulation Authority, and the government to stimulate the economy, especially small businesses, with $90 billion. So at a percentage of 25 basis points to the banks. So that gives the banks the opportunity to on-lend to other SMEs. Indicative rates, I've heard, is 4.5%. So it's an unsecured loan, 3 years, with an initial 6-month repayment holiday. So if you get a loan today, you won't have to have any repayments for 6 months. So hopefully get through this tough time. And I think it's the cheapest credit that you'll get for the foreseeable future. I've looked back I did a bit of research, lowest since the 1300s. So it's probably a good time to consider it as an option. But if your business is in a financial stable situation, potentially looking to talk to a broker to assess options to keep the cash flow going.
I mean, I'm going to be cynical here as an ex-banker, right?
Yeah.
Who's lent during a recession, all right?
Mm-hmm.
And that was tough. The credit guys, as soon as the word recession comes in, the walls go up in credit, and it's sort of, why should I do this deal? So I guess my point would be, are the banks actually going to embrace this? I mean, Tim, let's bring you on this, because you're at the sharp end as well. Knowing what you know of banks, having been through recessions yourself, do you think banks will welcome this with open arms?
Historically, you're absolutely right, Tim. They don't like to go deeper in during these types of downturns. But this is an interesting formula that the government has quickly put together, and it is 50% secured by the government. That might soften it enough for the financial institutions to think more positively about it. Certainly, if without the guarantee sitting there, it would be very hard sell. They wouldn't be doing the right thing by the community, because that's not what banks do. It's such a novel offering and initiative. It's hard to say. I hope they take it on. I think it's a fantastic source. The old adage that when you need money, you can't borrow it, and when you don't need it, you should borrow it.
Yeah.
So if it's sitting there, I'd certainly, for most organisations, I'd just jump in. It obviously doesn't suit some organisations that are larger and the like. It's very, it's just small change. But
I think the point you made, Tim, is really, really important about if you don't need it, raise it. And what we've seen more in the States, I have to say, is a number of the big corporations who've actually got massive lines that they've negotiated with the banks. As soon as the share market cascaded, they drew right to the limit of those borrowings. And the private equity firms that were backing up those companies said to their lending companies, borrow every single cent, because they will cut it. That was their sense. But I guess, I'm just really concerned that I think for startups especially, will the banks actually help? I mean, because if there's no balance sheet, or there's value maybe in the intellectual property, that's very hard to value. So I don't know, what's your sense, Sid? I mean, you're talking to, you mentioned the other day, I won't talk about the specific banks that you spoke with, but you spoke to a number of bankers. And obviously a lot of your clients are startups. What were the bankers' views generally?
So their ability to lend is greater now, because APRA has relaxed some of their lending, the capital ratios. So, right. Which has helped us, avoid the last recession, because, our regulation system wants our banks to be very solid from a capital point of view. So they've relaxed that. So, but I don't think, if your startup is in the first year and it's pre-revenue, it's going to be very difficult to get an unsecured loan, because I don't think the banks will see the path to repayment. In that case, look to investors, as Trina and Cheryl were talking about. Potentially a VC can, if they love your idea so much that they can back it and help you through this. But if your startup is 2 to 5 years and you can show a track record of financials with a growth happening there, I think it's a good chance you can get the unsecured loan.
Okay, so for those that are sort of scale-ups in some ways, those may have more of an opportunity to raise funds, is what you're saying, essentially.
Certainly.
And I guess, Cheryl, from your perspective, startups are going to be really challenged, let's be honest, in terms of where they're going to be. So, Tim, let's bring you in on this, because this is your core area here. If we've got the situation where the banks say no and the investors say no, and people are facing the challenge of having to either close the business or sell it or whatever it might be, are there alternatives to just straight liquidation or administration? Are there alternatives?
There's always alternatives, and it depends on the environment you find yourself in. It depends on the stakeholders that are engaged and involved with whatever business you have. There's a myriad of variations on the theme here. If the startups don't have a significant liability balance sheet, but they can't see how their business model is going to turn over in the next 6 months or 12 months while this unfolds, the term being used at the moment is to mothball it in whatever way you can. It may be that you reach independent agreements with the relevant primary stakeholders that are engaged with you, and you work out a strategy to try and have the business set aside and protected, but not operating during the period. It sounds very easy in theory. I know there'll be a lot of practical problems attached to that. If you had a business that does have a balance sheet and has liabilities, but no operations that can be foreseen moving forward, there's some mechanical compliance techniques through voluntary administration that could go into some holding deeds of company arrangement, which is something that allows you to buy time. It doesn't, you don't necessarily do anything with the operations. They don't necessarily trade on, but everything is preserved, waiting for a trigger or something further down the track.
So this deed of company arrangement is just like Chapter 11 in the States, is that right?
There's a lot of similarities. It prevents any of the creditors from being able to attack the company in the sense of trying to liquidate the company. The deeds, once a company goes into voluntary administration, it's because theoretically the company is insolvent or is likely to become insolvent. It is then a matter of a proposal being put to the creditors of the company at that time to demonstrate that what the proposal looks like is a better outcome than what the company would, what the creditors would get if the company was liquidated. And that is, that's been around for 25 years now. It will come into its own over the next 12 months to 2 years, depending on how this unravels. But I can imagine that we will be seeing a lot of voluntary administrations and deeds of company arrangement in the next, not in the next month or two, but certainly as this unfolds. If I could just also say quickly that what the government has done has tried to provide an environment which allows the corporations to get some breathing space so they're not distracted by people trying to wind them up or try and get the money out of them. There's been extension of statutory demand times. There's a long period before you can wind up a company now. That all gives organisations breathing space, and they can think through some of these strategies a lot more effectively than having to try and be distracted by trying to ward off unhappy creditors.
So is it, I mean, in terms of approaching these types of mothballing structures, is it better that they talk to someone like yourself, for example, if people are facing that type of issue of, this is a doomsday scenario, we're just heading one way, and try and preserve that value? And do you think creditors will either sort of buy into that, or they'll be more accommodating given that this situation has just been shoved upon everybody? I mean, we've not had a choice essentially in this. It's not like, there was a massive automatic correction in the stock market that everyone knew was coming, or just part of the economic cycle. This is an exogenous force. What's your sense of the way that creditors react?
Yeah, I think the creditors are going to have a longer fuse on this one. I think they're going to be, I don't know whether sympathetic's the right word, but they will try and participate and support the business models as best they can. Most of these businesses, as I said from the start, didn't have a track record of bad credit leading up to this. They were all very solid corporate citizens, and particularly startups would have that. There'd be no bad reputational issues for them in that respect. And the supply chains actually want the businesses to get back on the feet. They will go a long way to accommodate. They also know that if they wind the companies up, if the companies wind up, they're not going to get much out of it anyway, potentially. So they'll want to support it because they want the businesses to come out the other side, so they've got customers coming out the other side. I believe it will be a different environment that we're finding ourselves in, and I think your directors, shareholders and the like do need to get input from people like myself, from lawyers, from the other members of the panel, just to get a full understanding of the aspects and issues that they're going to be confronting. Most businesses that are traveling well never really have to drill down on insolvency issues and the various elements that affect them. You do need to talk to someone like myself to feed in to the thought process. It's not a matter of whether it's going to go into voluntary administration, it's just knowing what the parameters are so that you can build that into your models.
Okay, look, Tim, that's really sound advice. Go on, Trina, go on.
Sorry, Tim, Heish, I think the other really important aspect to this for the founders, particularly if they've borrowed capital, or raise capital, is there responsibilities under the Commonwealth Corporations Act as directors and insolvency? And I believe that the ACCC came out with some changes to the Insolvency Act. Are you able to expand a little bit on that for those that are listening? Because I think it's vitally important given the criminal and civil penalties that directors potentially are up against.
Yeah, no, thank you, Trina. That's a good question. It was a change to one very fundamental principle that the Australian economies we work under and companies work within. It's the insolvent trading provisions, I think, is one of the things that you're referring to. And for 25 years, we've had legislation that says if a company is in a situation where the directors think the company might be insolvent or likely to become insolvent, but they continue to trade on the company and the company eventually goes into liquidation, then there is a capacity for the liquidator to go back to the point where those directors should have known it was insolvent or did know it was insolvent, and those directors can be personally liable for the debts that that company incurred from that point on. The last government brought in some legislation that was left field, and it was called Safe Harbour. Safe Harbour was introduced to assist directors in trying to preserve the companies and the businesses who were afraid of the insolvent trading provisions. So the insolvent trading provision was a motivation, something to motivate directors to put the company into voluntary administration so that they didn't incur unnecessary credit. But that made directors afraid, and so they would pull the pin too early, and therefore not giving the business model of the company enough chance to recover without going into voluntary administration. So the last government then introduced Safe Harbour that said, if you go into this Safe Harbour regime, which is not reported, it's not publicly listed, and you tick a few boxes, you will protect yourself from insolvent trading as a director. That was helpful, but it wasn't utilised too much. And the government has realised right now that they can't have the risk of insolvent trading provisions impacting on the way directors motivate themselves under these circumstances. So they've given a 6-month reprieval or withdrawal of that particular legislation. So moving forward over the next 6 months, if directors feel that they believe they can trade out of this, but do incur credit and it ultimately falls over, those directors will not be personally responsible for those debts. That said, directors are still responsible for their fiduciary duties to manage a corporation in accordance with those duties. And if they are reckless in what they do now, thinking, hey, I'm protected, no one's going to come after me personally, there is still the risk that they will get themselves into trouble with a liquidator chasing them later on if they are recklessly abusing this situation under the current circumstances. Does that answer your question?
It does. I think it's important for those that are listening, because the majority will be directors, and ensuring they understand there are some very critical issues they need to understand and high penalties if they don't act responsibly as a director.
Yes, no, they are high penalties for sure.
Yeah. Look, I mean, I think the key thing that I think has come out of all this is that there are definite challenges over the next 3, 6, 9 months that are coming through. It's clear that investment funds are much harder. It's clear that banks are going to be very tight. And I think, we're going to face challenges with customers either deferring contracts or stopping them. So I think the key thing that brings this right back to the beginning again, when I first started looking at this, it was about, it was very much, are people okay? And I think the key thing is there's going to be a bucket load more stress that's going to be laser focused on founders. And I think it's so important that as a community, we actually get together and actually support everybody. Now, at the end of last year, there was this great campaign of Are You Okay? And for me, it's about, each and every one of us just literally being aware of other people in the startup community who may be facing incredible stress. You can see from the conversations we've had tonight that have been really insightful that there are real challenges that everybody is going to face. And I think it's about, we've got to look after each other. And I would just say openly, literally aim to speak with 3 founders a day, just one quick text or one quick phone call, just to say, are you okay? Because I think it's going to be incredibly important. But I think just to some positive note, for 30 seconds, because we're just slightly over time, I want a 30-second soundbite of what everybody should actually do. One thing would be the key tip for startups over this next 3, 6, 9 month period. 30 seconds, your key tip. We'll start with you, Sydney, with Sid.
Didn't want to start off, but okay. Key tip, I think, business is all about relationships and people. So, make sure that you're talking to your trusted network to figure out a way to get through this tough time together. That's what made us such an amazing species. Our ability to work as a team and as a network to create something amazing. So good luck to all the founders out there. Feel free to reach out because love to see what you're up to.
Okay, excellent. Thank you, Sid. And Trina, what would be the one thing that you'd say to everybody? Just one key tip.
Wash your hands.
Okay. Wash your hands. Well, wash your hands of all the financial debt and not worry about it, or just wash your hands and just...
No. From COVID, obviously. No, do scenario planning. Do financial scenario planning, 3, 6, 9, 12 months. Build out a worst case scenario. Some say manage to worst case scenario. Not sure about that, but at least do scenario planning. Understand your position, understand your data points, your triggers that you should be watching daily, and manage and go forward. And as you rightly said, Tim, mental health is everything in these times.
It's absolutely critical. Cheryl, go on. Give us your 30 seconds.
Yeah, so founders, I want to say focus. This is not the time to get distracted with, potential partners that could look good as strategic things. It's not the time to get distracted with, potential overseas investors that are just trying to get your IP out of you. It's not the time to have random virtual coffee meetings with people just because they want to meet up. This is the time to focus on executing well. Solve your customer's pain point and solve it really well. Keep in touch with people in your network and let them know what you're doing, but don't let that distract you from what you're doing, because focus is going to get you through this.
That's great advice, Cheryl. And Tim, give us your 30-second. What would be the key tip that you'd say to every startup founder there, besides don't talk to me? Seriously, your 30-second tip.
Yeah, this environment for me, I'm not afraid of it, because this is what every business I deal with is stressing out all with their particular situation. I look at it and I say that there are many things that is still within the control of the directors and the shareholders of these entities. It's not a time to panic. It's a time to work out all of your parameters. As Cheryl said and the other panel members, it's about planning, looking at your scenarios, and getting the information. If you don't know about how things might play out in certain areas, do go and see an advisor. Get that information from them. Feed it into your decisions and your business models, and at the end of the day, 2 things. Everything is negotiable. Even if you think you are in dire straits, it is negotiable. And secondly, do not panic.
Thanks, Tim. It's very, very sound words. Look, guys, Cheryl, Sid, Trina, Tim, and Brad behind the scenes, look, thank you so much for devoting your time to this. I think as more and more people hear about the solid advice and comments that have come out of tonight, I think more and more people will just be aware, and they'll be sharing what all the pearls of wisdom that you've said. And I think I just come back to the key thing. There'll be a lot of stress out there, and I think everybody within the community has got to help everybody else. If you think somebody is suffering, just reach out and help them whichever way you can. And I think it is, as Trina says, wash your friggin' hands, keep yourself safe. And, we will come out of this, but we don't know exactly when we'll come out of it. But it's like, I remember there was an old mentor of mine many years ago. This was during the first recession I survived, where he said, booms and recessions are both the same. When you're in one, you think neither is going to end. And this virus will end at some stage. And when we come out of the back end, there'll be lots of ideas that we've all thought of, lots of better ways of doing business, and lots of better ways to approach the investors that Cheryl knows, to approach the bankers that Sid knows, to get the customers over in the States that Trina knows. And sure as hell, don't talk to Tim. No. On a serious note, if you are facing real challenges, it's really important to talk to someone like Tim, who knows the best way out of the very difficult situation. So guys, and to Brad, thank you very much for all the background stuff, getting questions answered and that type of thing. We will make this available, hopefully, we'll put the link to the recorded version, and we'll do a nicer version in the next week or so. Stay safe, and as a startup community, let's do this. Let's just work together. Thank you, guys. We'll speak to you very soon in the next one. Thanks again.
Thank you.
Thank you.